G'day folks, welcome back to another update for Bitcoin. Now it's turned bullish on the daily chart, although it's still overall bearish on the monthly and weekly. We'll get into the charts in a minute, and we're going to include some back testing as well. Make sure you hit that like and subscribe button to support the channel. In terms of the outlook, as of today, March 25th, Bitcoin's fundamental outlook is influenced by recent price volatility, regulatory developments and broader economic factors. After reaching a record high of $109,000 earlier this year, Bitcoin has declined to around 84,353, reflecting a 20% drop. This downturn is partly attributed to concerns over US tariff policies and global economic uncertainties. Additionally, President Trump's initiatives, including the creation of a US strategic Bitcoin reserve, have introduced market fluctuations. While the reserve initially boosted prices, subsequent restrictions on new cryptocurrency purchases led to investor disappointment and price declines. Despite these challenges, Bitcoin's market capitalization remains robust at $1.63 trillion, indicating sustained investor interest. However, the impending advent of quantum computing poses a potential threat to Bitcoin's security framework, as quantum computers could potentially undermine current cryptographic protocols. Overall, while Bitcoin continues to be a significant player in the financial landscape, its future trajectory will depend on how it navigates regulatory changes, technological threats and macroeconomic dynamics. So we always look at the long-term trends first. You can see here on the monthly chart, the price is still above its moving averages, although notice the CCI 150 is actually broken into that moving average range, and it's in the middle of that range at the moment, and it very likely may drop further, possibly. So still somewhat bullish to neutral on the monthly. On the weekly, however, we did have this bearish divergence, lower highs on the CCI versus higher highs on the price. That actually broke through our 23-38% minimum range, and it's actually still falling and broken below the moving average of the price and also below the moving average of the CCI. In terms of that retrace, we draw a Fibonacci from that high to that low. Let me just expand that. You can see that's at 23-38% minimum retrace, and it's gone as far as a 50% retrace, and it's bounced. It's currently in that 38% range, currently trading. Could possibly fall further, but it's got a slight move to the upside on the weekly. On the daily, that's already broken below the moving averages of both the price and the CCI, although notice it's now currently a fresh breakout to the upside on the daily above the CCI moving average and also the price moving average. So a slight bullish movement on the daily after hitting that resistance up there at 108,263. Didn't quite get as far as this support level at 66,440, but again, that's not out of the question yet, considering the weekly is still bearish. So this may actually retrace further to the downside. So again, we'll keep a close eye on that. Now, if we go to the 1 hour chart, we look at the intraday as well and see how that compares to the daily. Remember, our trading rule is we trade in direction of the higher time frame, so we trade in direction of the daily, and currently you take long trades only. But notice on the hourly, you've got this bearish divergence as well, and that's broken down through that moving average range on the price, but also the CCI. And if we draw a Fibonacci to that level, we take it back to the previous low before that divergence started. You can see there that current candle is actually broken into that 23-38% range, which is our minimum retrace, and that of course can still drop further. So again, even though the daily is showing a bullish move, avoid going long until we see this break more convincingly above on the hourly to be more confident of that bullish move. But at the moment, it's looking more bearish than bullish. In terms of back testing, what we've got here, we take the back test and we started it back here when the price broke below the moving averages, but also the CCI was below the moving average as well. That's indicated by these 2 points. So the top chart here is a profitability chart for the stop loss approach. And this chart here is the profitability for the average down approach. The stop loss approach with a baseline of 100,000 has generated 7,785. The average down with a baseline of 100,000 has generated 182,574. Stay to the end of the video and I'll show you the trading parameters for those two trading strategies. So they both return something. Now where I've got these marked with X's, that's where you would have closed out the position when the daily hit that moving average range on the CCI. So each of these points where it touches the moving average range, you close out your positions, and then you reopen it once the price and the CCI breaks below again. That's how you trade on the hourly as well. So again, you would have taken out, you closed your positions, whether it was a loss or a profit, you would have closed out your positions. whenever you see that, don't let it run. So here are the backtesting or trading parameters. So if you're trading on the 1 hour time frame, you invest per trade 1 contract, the first contract entered, and you average down limit of 15 contracts. So basically the contract entries, the first one is 1 contract, next lot is 3, you've got a total of 3 contracts now running, add another 4, you've got a contract, 7 contracts running, add another 8, and then you've got a final of 15 contracts maxed. And every time you average down, you make sure it drops by at least 0.005% for a 1 hour trade or contract parameter. If you're trading on the daily, the average down is 5% decline. Now, trading shares is very similar. Invest per trade $1,000 per trade. So you invest first $1,000, next lot is $3,000, next is $7,000, and finally you got the max of $15,000. And again, average down by 5% if you're trading on the daily time frame, and take profit of 3%. If you want to follow the traditional stop loss strategy for trading CFDs on the 1 hour time frame, you invest 1 contract per trade, take profit of 0.003% or 3% for a daily trade if you're trading on the daily time frame, and a stop loss is when the CCI 150 turns into the moving averages. Likewise, if you're trading shares, if you're trading on the daily time frame, invest per trade $1,000, take profit is 3%, and again, stop loss when the CCI 150 turns into the moving averages. Obviously, you can invest more than $1,000 in any of these trades, but you've got to be very careful of the your money management and your account balance. And I've limited it to 3% take profit on the daily and 0.003, the equivalent for the 1 hour time frame, because I found if you make it too high, in other words, if you aim for a 5 or a 10% gain, often you're a lot longer in the trade than you really expected, and it just gives you a lot more turnover when you're the smaller take profit return.
To support the channel, hit that like and subscribe button, and for added benefits and for a cost of a coffee each month, consider subscribing to the Patreon page where we look at weekly scans of bullish shares across various regions. Thanks for watching, and see you in next week's video.